Something happened that the mainstream financial media almost completely missed. While most investors were staring at their stock portfolios, watching the Dow Jones tick up and down, worrying about quarterly earnings reports, a seismic shift was unfolding underneath the surface of the global financial system. A shift so significant, so structural, so fundamental to how money works on this planet, that it sent gold surging to levels that would have seemed unthinkable just a few years ago. And here's what should concern every single person watching this video. What we're witnessing right now is not a spike. It's not a blip. It's not a temporary reaction to some headline that will fade in a news cycle. What we are watching is the beginning of a complete and total restructuring of the global monetary order. And if you're sitting on savings, on retirement accounts, on a nest egg that you've spent decades building, what you do in the next few months may define the financial security of the rest of your life. So let's talk about what's actually happening, because I guarantee the full picture is far bigger and far more urgent than anything you've heard on CNBC or Bloomberg. First, let me ask you something. Have you ever watched a pressure cooker build steam for an hour, maybe 2 hours, and then just explode? That's what we are looking at in the gold market right now. This didn't happen overnight. The pressure has been building for years, decades really. But certain geopolitical events, certain decisions being made in conference rooms in Beijing, in Moscow, in Riyadh, in New Delhi, have just turned up the heat dramatically. And the gold market, which never lies, which cannot be manipulated by a press conference or a government statement, is telling us exactly what it thinks about what those decisions mean for the US dollar and for paper money in general. Let's start with the most important number that almost nobody is talking about. For the first time since 1996, think about that. For the first time in nearly 3 decades, central banks globally are holding more gold than US Treasury bonds in their reserves. Let that sink in for a second. For 30 years, the United States Treasury was the gold standard, no pun intended, of global reserve assets. Every central bank on Earth, from Tokyo to Nairobi, wanted to hold American government debt because it was considered the safest, most liquid, most trusted asset on the planet. And now those same central banks are quietly, deliberately, methodically replacing those treasuries with physical gold bars. That is not a small thing. That is a historic, tectonic shift in confidence in the American financial system. And the countries leading this charge? The BRICS nations. Brazil, Russia, India, China, South Africa, and now a rapidly expanding coalition of nations that have joined their ranks. These countries have collectively accumulated over 6,000 tons of gold. 6,000 tons. That is a staggering war chest of physical metal, and it didn't happen by accident. This is a coordinated, intentional strategy. These nations have watched what happened when the United States weaponized the dollar, when American sanctions froze Russia's dollar reserves overnight in the aftermath of the Ukraine conflict. They watched that, and they said very clearly, we cannot allow our national wealth to be held in a currency that a foreign government can freeze with a phone call. Gold cannot be sanctioned. Gold cannot be frozen. Gold does not have a counterparty. And so they buy. Month after month, year after year, they keep buying. Now, before I go further, if you've been watching this channel for a while, you know I occasionally flag resources that I think are genuinely useful for people in your position, and I want to do that real quick. I put together a free guide that goes deep on the strategies that thousands of American retirees are already using to protect their hard-earned wealth from exactly the kind of monetary turbulence we're talking about right now. It's in the description below. Grab it, it costs you nothing, and we'll come back to that at the end of this video as well. Now, let's keep going, because the geopolitical story gets even more fascinating. Here's a concept I want you to really internalize: de-dollarization. You've probably heard that word thrown around, but most people don't fully grasp what it means or how far along this process already is. When World War II ended and the world gathered at Bretton Woods in 1944, the nations of the world made a deal. All global currencies would be pegged to the US dollar, and the US dollar alone would be pegged to gold at a fixed rate. America became the world's banker. The dollar became the world's currency. Every barrel of oil traded, every shipment of rice or semiconductors or copper, every international transaction on Earth, all of it settled in dollars. This gave the United States extraordinary power. It meant America could print dollars and the whole world would absorb them. It meant American debt was always in demand. It essentially allowed America to live beyond its means for decades because the rest of the world had no choice but to keep using the currency. And then something started to crack. In 1971, President Nixon stood before the American people and announced that the United States was ending the gold convertibility of the dollar. Just like that, in a single Sunday evening television address, the gold standard was dead. From that moment on, the dollar was backed by nothing except the full faith and credit of the US government and the strategic dominance of American military and economic power. For decades, that was enough. But fast forward to today, and that faith is fracturing. The dollar's share of global reserves has plummeted. In 1999, roughly 71% of global foreign exchange reserves were held in US dollars. Today, that number has fallen to somewhere around 56%, and it's still falling. That is a structural decline in confidence in the American currency that no Federal Reserve press conference can reverse. Here's where the geopolitical shift comes in, the one that just sent gold spiking. The BRICS summit framework has been pushing hard for trade settlements outside the dollar. Saudi Arabia, the country that has been selling oil exclusively in dollars since the 1970s, a deal that essentially created the petrodollar system, has been openly discussing conducting oil trades in alternative currencies. India has been settling energy trades with Russia in rupees. China has been pushing the yuan as a settlement currency across Asia and Africa. And perhaps most critically, multiple nations are now moving toward linking their central bank digital currencies, CBDCs, together in a network specifically designed to bypass the SWIFT system, which is the backbone of dollar-denominated global finance. When that network goes live, and experts believe it is closer than most people realize, the dollar loses another layer of its dominance. And every percentage point of dominance the dollar loses is a percentage point of demand that flows somewhere else. And increasingly, that somewhere else is gold. Think about what this means from a pure supply and demand perspective. We have demand for gold exploding from institutions, from central banks, from retail investors across Asia and Europe. We have JP Morgan, one of the most prestigious financial institutions in the world, projecting gold prices could climb to levels that once seemed like the stuff of fever dreams. We have the World Gold Council projecting continued structural strength. We have Bank of America analysts talking about silver potentially hitting triple digits per ounce in the coming years. And on the supply side, global gold mining production has barely budged. The big, easy-to-find gold deposits were mined out decades ago. The majors, Barrick, Newmont, Agnico Eagle, are spending more money to mine each ounce than they ever have before. You can't just turn on a tap and produce more gold because prices are high. It takes 10 to 15 years and billions of dollars to bring a new mine online. So you have surging demand crashing into constrained supply, and the price of gold is simply the market's honest reaction to that fundamental reality. Let me take you back in history for a moment, because this is where it gets really interesting. In 1971, right after Nixon closed the gold window, gold was priced at $35 per ounce. By 1980, just 9 years later, it had surged to over $850 per ounce. A single ounce of gold went from $35 to $850 in less than a decade. That's not a rally. That's a complete repricing of the world's understanding of what paper money is worth. People who held gold through that period didn't just preserve their wealth, they multiplied it. People who held cash watched their purchasing power get quietly, systematically destroyed by inflation. Because here's the thing about the 1970s that most people today don't fully appreciate. It wasn't just high oil prices and long gas lines. It was the consequence of removing gold's anchor from the monetary system. When you take away the discipline of convertibility, governments print. And when governments print, the currency inflates. And when the currency inflates, the cost of living rises. Savings evaporate, and the middle class gets squeezed until they can barely breathe. Now look around you. What do you see? Government spending at levels that would have been considered impossible just 20 years ago. National debt growing not by billions, but by trillions every single year. Inflation that, even though governments claim has cooled, has fundamentally reset the price of everything in your life. Groceries, healthcare, insurance, energy, housing. The supermarket bill that used to be manageable now requires a double take at the register. That's not temporary. That's monetary debasement working exactly as it always has throughout history. The 2008 financial crisis is another crucial parallel. When Lehman Brothers collapsed and the entire global financial system teetered on the edge of catastrophe, what did central banks do? They did the only thing they knew how to do. They printed. The Fed's balance sheet went from roughly $900 billion before the crisis to over $4 trillion within a few years. They called it quantitative easing. They gave it a technical name to make it sound like sophisticated policy. But what it was, in plain English, was money printing on a scale the world had never seen. And gold knew it. Between 2008 and 2011, gold rose from around $700 per ounce to nearly $1,900 per ounce. Not because the world suddenly decided gold was a fashionable investment, but because smart money, institutional money, foreign central banks, sophisticated investors understood exactly what that money printing meant for the long-term value of the dollar. They bought gold as insurance, and that insurance paid off spectacularly. Now, here's what makes the current moment different, and frankly, more urgent than any of those previous episodes. In 1971, de-dollarization wasn't really a conversation. In 2008, BRICS countries were still relatively junior players in the global economy. Today, the geopolitical landscape has fundamentally changed. China is the world's largest trading nation. BRICS nations collectively represent nearly half of global GDP on a purchasing power parity basis. The infrastructure for trade outside the dollar, from digital currency networks to commodity exchanges priced in alternative currencies, is being built in real time. And the confidence that foreign nations once placed unconditionally in U.S. institutions, in U.S. governments, in U.S. fiscal responsibility has genuinely eroded. This isn't anti-American sentiment. This is practical risk management by governments that have watched Washington weaponize the dollar as a geopolitical tool and decided they don't want their national wealth held hostage to that weapon. Now let's talk about what is happening inside the market structure itself, because this layer of the story is the one that most retail investors never see. There is a critical distinction between paper gold and physical gold that almost nobody explains clearly. The COMEX, the commodity exchange in New York, is the dominant gold futures market. Every single day, contracts representing hundreds of millions of ounces of gold change hands on that exchange. But here's the thing. The actual physical gold that backs those contracts represents a tiny, tiny fraction of the total paper gold outstanding. We're talking about dozens of paper claims for every single ounce of physical gold that exists in the vaults. This works fine until it doesn't. Until a moment of genuine financial stress, when contract holders start demanding delivery of actual physical metal rather than a cash settlement. When that happens, when the paper market meets the reality of physical scarcity, the repricing is violent and immediate. Analysts who study COMEX mechanics closely have been flagging this vulnerability for years. The registered gold inventory at COMEX, that's the gold actually available for delivery, has been in structural decline even as paper trading volumes have grown. That is a tension that resolves one way and one way only. The price of physical gold goes dramatically higher. Meanwhile, the London Bullion Market Association, the LBMA, which handles the world's largest over-the-counter gold market, has similarly been watching physical outflows as demand from East, from China, from India, from Middle Eastern sovereign wealth funds, continues to pull metal out of Western vaults. There's a slow-motion migration of physical gold from West to East that has been happening for years and is now accelerating. And as that gold moves, the West's ability to suppress price discovery through paper instruments diminishes. The physical market increasingly sets the price, and the physical market is screaming that gold is significantly undervalued relative to its true monetary role in the emerging global financial architecture. Here's where I want to pause and speak directly to you, especially if you're in or approaching retirement, because everything I've just laid out is not academic. It's not theoretical. It's happening right now, and it has very direct, very personal implications for your financial security. You've spent decades working. You've saved diligently. You've accumulated retirement accounts, IRAs, 401ks, pension funds, savings accounts. And now you're watching a world that seems increasingly unstable. Stock markets that move up and down based on Federal Reserve whispers, bond markets that have delivered historically poor returns in an inflationary environment, a dollar that buys less every year than it did the year before, and geopolitical tensions that the experts themselves admit they can't reliably forecast. This is exactly the environment that gold was designed for, not as a get-rich-quick speculation, not as a trade, as insurance, as a store of value that has held purchasing power across 5,000 years of human civilization, across the rise and fall of empires, across world wars and currency collapses and financial panics. Gold survived Rome. Gold survived the Weimar Republic. Gold survived the Great Depression. Gold survived 2008. And gold will survive whatever comes next. Quick aside, and I genuinely want to make sure the right people hear this. If you have $100,000 or more in a retirement account, there's a way to get physical gold into that account without triggering tax penalties. It's called a gold IRA, and I put together some resources on how it works, how people are actually moving a portion of their existing retirement savings into gold-backed accounts to hedge against everything we've been talking about. Market collapse risk, geopolitical instability, dollar debasement, inflation that hasn't gone away no matter what the official numbers say. The process is more straightforward than most people realize, and the tax advantages of doing it through a proper IRA structure are significant. Check the description for details. Now, let's keep going, because I want to show you what the smart money is actually doing right now. When JP Morgan Research, the analytical arm of the world's most powerful bank, publishes reports with targets that sound almost surreal to the average investor, pay attention. When Morgan Stanley is telling institutional clients that the structural case for gold has never been stronger, pay attention. These institutions are not gold bugs. They are not conspiracy theorists. They are some of the most hard-headed, numbers-driven analysts in the world. And they are saying, loudly, clearly, in expensive research reports, that gold's role as a strategic reserve asset is not a trend. It is a permanent structural shift. JP Morgan has reportedly been positioning its own commodity portfolios accordingly. Hedge funds, family offices, sovereign wealth funds from Norway to Abu Dhabi have been increasing gold allocations. This is not retail speculation. This is sophisticated, long-horizon capital making a generational bet. And here's the fascinating paradox that gold creates in this environment. The worse things get, the more geopolitical tension, the more fiscal irresponsibility, the more monetary debasement, the better gold performs. Gold is the asset that thrives precisely when everything else is under stress. It's not correlated with stock market performance. It's not correlated with bond yields in the traditional sense. It's correlated with trust, or more precisely, with the erosion of trust in paper-based financial systems. And trust in paper-based financial systems is eroding at a pace we haven't seen since the 1970s. Think about the Basel III banking regulations for a moment, because this is another piece of the puzzle that most retail investors have never heard of. Under the new Basel III framework that has been implemented across major global banking institutions, gold has been reclassified as a Tier 1 asset. That means gold now sits alongside cash and government bonds at the top of the regulatory capital hierarchy. Banks can now hold gold as high-quality liquid assets. The implications of this are enormous. It means that globally, banking institutions now have a regulatory incentive, not just a preference, an actual regulatory incentive to hold more gold. That is structural institutional demand that doesn't disappear based on a quarterly earnings report or a Federal Reserve meeting. And consider the mining side of this equation one more time, because the supply story is one of the most underappreciated elements of where gold goes from here. Gold production globally has essentially plateaued. The major discoveries, the massive deposits that fed the bull markets of previous decades, have been found and largely depleted. The industry is spending dramatically more money per ounce of gold produced than it was a decade ago. All-in sustaining costs for major miners have risen substantially over the years. New mines take a decade or more to develop from discovery to first production. There is simply no mechanism by which supply can respond quickly to higher prices. Demand can surge in a matter of months, and it has. Supply cannot. And that fundamental imbalance is one of the most powerful price drivers in commodities markets. It's the story of oil in the 1970s. It's the story of copper over the last 2 decades. And it is increasingly the story of gold right now. There's also a dimension to this story that connects directly to the ordinary American household in a way that often gets lost in the macro analysis. The wealth gap in this country has widened dramatically over the past 2 decades, and the mechanism of that widening is not complicated. Asset inflation, driven by low interest rates and massive money printing, has enriched the people who own assets. The people who own stocks, who own real estate, who own companies, who own gold, have seen their nominal wealth surge. The people who hold their savings in cash, in savings accounts, in money market funds, they've watched that wealth quietly evaporate in real terms. This is not a political statement, it's basic monetary arithmetic. When the money supply expands dramatically, the value of existing money decreases. The wealth you saved in dollar terms buys less and less over time. The only protection against this, historically, is owning assets that hold their value independent of whatever the Federal Reserve decides to do with interest rates or the printing press. Gold is the original hedge against this process. The grandparent who kept gold coins in the 1930s or the 1970s wasn't paranoid. They were financially literate. They understood, often intuitively, what the academic economists were slow to admit, that governments always inflate. Always. Not because they're evil, but because inflation is politically easier than fiscal discipline. Printing money to pay debts is always more attractive to politicians than raising taxes or cutting spending. So the inflation happens, and the currency slowly, steadily erodes. And gold, patient, immovable, unmanipulable gold, sits there, holding its value across generations. We are now at a confluence of forces that gold investors have been waiting for. You have the structural de-dollarization trend accelerating. You have central banks making historic moves away from treasuries and toward physical gold. You have Basel III embedding gold into the regulatory fabric of global banking. You have the COMEX paper-to-physical ratio at levels that historically precede major price dislocations. You have geopolitical tensions across multiple theaters simultaneously, from the Middle East to Eastern Europe to the Taiwan Strait, all of which send safe haven flows directly into gold. You have a Federal Reserve that, despite rhetoric about inflation fighting, has fundamentally limited room to raise rates dramatically without triggering a debt crisis, given the scale of U.S. government borrowing. And you have supply that simply cannot respond to any of this on any timeline that matters. The institutions that study this for a living, the World Gold Council, J.P. Morgan Research, Goldman Sachs Commodities, Morgan Stanley, are not in agreement on everything, but they are in striking agreement on one thing. The structural case for gold has never been more compelling, and the current geopolitical realignment represents the kind of once-in-a-generation shift that historically produces the biggest and most sustained gold bull markets in history. Now, let me also address something directly. I know there are people watching this who've heard gold talked up before, who remember the peak years around 2011 and 2012, who bought in near those highs and then watched the price come back down over the following years. I understand that experience, and I want to acknowledge that gold is not without volatility. Short-term corrections happen. Price dips happen. Anyone who tells you otherwise is not being honest with you. But here's the critical distinction between then and now. In 2011 and 2012, the de-dollarization trend was theoretical. BRICS nations were growing, but hadn't taken the explicit structural steps toward alternatives to the dollar that we're seeing today. The Basel III Tier 1 classification for gold didn't exist yet. The geopolitical fracturing between the Western-led order and the BRICS coalition hadn't reached its current depth. And critically, inflation had been relatively contained. The Fed was able to raise rates and stabilize the dollar environment in a way that temporarily reasserted dollar confidence. Today, the fiscal situation makes that kind of aggressive rate response far more constrained. The geopolitical realignment is far more advanced, and the institutional, structural demand from central banks and regulated financial institutions is orders of magnitude larger. The parallels to 2011 are superficial. The underlying conditions are categorically different. Which brings me back to where I started, that massive, largely unreported geopolitical shift that sent gold spiking. The specific trigger matters less than the underlying current it reveals. Whether it was a BRICS summit statement, or a central bank announcement, or a trade settlement news story, or a decision by a major oil-producing nation to price a shipment in a non-dollar currency. The specific headline is just the latest visible manifestation of a tectonic process that has been underway for years and has now reached a critical velocity. Every time you see gold spike on geopolitical news, what you're really seeing is the market repricing the probability that the existing dollar-dominated world order continues to function as it has for the past 80 years. And that probability, by any honest assessment, is declining. For the person watching this who has worked for 30 or 40 years, who has savings and retirement accounts that represent the accumulated effort of a lifetime, the question is not whether to care about this. The question is what to actually do about it. And the answer, I think, is not to panic. It's not to liquidate everything and bury gold coins in the backyard. It's to get educated, to understand the mechanisms, to make informed, deliberate decisions about how much of your retirement wealth is genuinely protected against monetary debasement and geopolitical risk, and how much is sitting exposed in assets that are deeply vulnerable to exactly the forces we've been discussing. That's exactly why I put together that free guide I mentioned earlier. It walks through the mechanics of how Americans have been moving portions of their retirement savings into gold, legally, efficiently, with full tax advantages intact, through gold IRA structures. It covers what to look for, what to avoid, how to think about allocation, and how to understand whether this kind of move makes sense for your specific situation. If you're an American retiree with retirement savings and you're watching the world we've been describing, this resource is directly relevant to you. It's in the description below. Grab it. It's completely free.